Are you looking to take your personal finances to the next level? Well, you're in the right place. Welcome to the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not, with your host, Joseph Sangle.
Well, welcome to the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not. We are fired up to bring this podcast to you every single Monday. And I'm joined, as always, by my co-host, Megan Hibbert. Are you fired up today?
Fired up. Happy Monday.
Up. And we're on episode number what?
171, and it is October 11th.
October 11th. Can you believe that?
It's wild.
You know, that is a magical time in South Carolina.
Yeah, it's like cool, but still a little bit warm.
So just so everybody knows, we're not recording this live, right?
It's true.
We are live as we're recording it.
We are.
But October 11th is a magical time in South Carolina because it is the opening day of deer season every year. And so there's a good chance as you're listening to this that I am somewhere 20 to 25 feet up in a tree and taking lots of pictures of wildlife. That's what I do. Lots of pictures.
Lots of pictures, yeah.
Lots of pictures. Not much success for my intended quarry, which is the beautiful, majestic white-tailed deer. But I only take ones that are very mean. So I just want to be clear. And they're organic vegetarian deer, so it makes me a second-generation vegetarian. I only eat deer that eat plants.
Okay.
That's awesome. So I probably offended some people.
Probably.
Sorry about that. You know, I do love the tradition of hunting and putting meat, quality, antibiotic-free venison in the freezer.
Yes.
And it's awesome. But today, are we going to talk about deer hunting?
No.
No more. What are we going to talk about?
Today, we are going to talk about how to know when to refinance. So our question is, mortgage rates are very low. How do I know when it makes sense to refinance my existing mortgage? We currently owe $2,000. Nope, not $2,000. That would be great if you owed $2,000. $231,703 with an interest rate of 3.75%. It was a 30-year note that we've been paying on for 4 years.
So I like it. We got specifics here, so we get to talk about it. And really the big question is how to know when to refinance your home mortgage. And we can't wait to talk about that. That's something that a lot of people encounter from time to time, particularly in an era of very low interest rates as we're recording this. Before we do that, though, we're going to talk about my favorite section of the podcast. Let's go.
Now it's time to get caught up with our current money events.
The Monday Money Tip Podcast is sponsored by the Fully Funded Life Membership Program. The Fully Funded Life Membership Program provides all you need to begin winning with money and live a fully funded life. Fully Funded Life includes 4 key components: courses, challenges, coaching, and community. Courses provide financial education. Challenges help you make massive progress in a specific money skill. Coaching is provided by the Fully Funded Life Certified Coaches through open office hours held multiple times each month. All of the courses, challenges, and coaching results in an outstanding community that help equip, motivate, and encourage you to take your next financial steps toward your fully funded life. Fully Funded Life. Courses, challenges, coaching, community. All that's missing is you. Learn more and receive a special offer for Monday Money Tip listeners today at fullyfunded.life/MMT. That's www.fullyfunded.life/MMT. Awesome. Today's current money events section is about raising the national debt limit. Maybe by the time you're hearing this podcast, we will have raised the national debt limit. But here's what I want you to know. That's unlikely. Now, I want you to understand what the federal debt limit is. And I have an article that's linked here in the show notes from CNBC. CNBC is my favorite business news outlet. I listen to that pretty much every morning and in the evenings. I like listening to Jim Cramer and Joe Kernan and Andrew Ross Sorkin and Becky Quick and all of them. But here's what I know. The federal debt is the amount of money the government currently owes for spending on payments such as Social Security, Medicare, military salaries, and tax refunds. And the debt limit allows the government to finance those existing obligations. So they get to finance it. Isn't that exciting? Yeah. And Congress must suspend or raise the debt ceiling or the country runs the risk of default. Default means not paying its bills. Congress is in charge of this, which Congress is notoriously, kind of a messed up area, and they don't really get along. And so Yeah, the future of our finances are in Congress's hands. And if lawmakers, this is the article that I've linked, if lawmakers can't reach a deal, it will increase borrowing cost, delay Social Security checks and veteran benefits, and disrupt financial markets across the board. So that's not good.
Yeah.
And raising the debt ceiling doesn't authorize additional spending of taxpayer dollars. Instead, when we raise the debt ceiling, we're effectively agreeing to raise the country's credit card balance, says Janet Yellen, the former chair of the Federal Reserve and the current Treasury Secretary. So think about that. Like literally, that is laughable.
Yeah.
It's a statement that Janet Yellen, and she is so smart, she could beat me with her brain tied behind her back. But here's what I know. She literally said something to try to make it so people understand. Think about that.
Yeah.
We raise the debt ceiling. We're effectively agreeing to raise the country's credit card balance. Why do we want to raise the country's credit card balance?
So you can spend more.
So they can carry more debt on it. She's not saying we pay it off every month. It's just we need to have more debt that we carry.
Yeah.
Does that work in personal finances?
No.
Hey, we're having financial issues. I know, instead of cutting out expenses, instead of having a balanced budget, let's just call the credit card company, who obviously has our best interest at heart, and ask them to raise the limit. Does any of that make sense?
No.
So Janet Yellen, I urge you to help the Congress see that they need to have a balanced budget. I know that's not your job as a Treasury Secretary, but you can to have a balanced budget, but you can urge Congress to have one. And then Congress and the White House, they have changed the debt ceiling almost 100 times since the end of World War II, according to the Committee for a Responsible Federal Budget. Sounds like an organization we need to be partners with.
Yeah.
That's a great name. Committee for a Responsible Federal Budget. In the 1980s, the debt ceiling increased to nearly $3 trillion from less than $1 trillion. Then in the 90s, it doubled to nearly $6 trillion. And it doubled again in the 2000s to over $12 trillion. Well, now, the national debt limit is currently just over $28 trillion.
Shoo.
Get fired up. In 2019, Congress voted to suspend the debt limit until July 31st, 2021. And now the Treasury is using temporary emergency measures to buy more time so the government can keep paying its obligations to bondholders, veterans, and Social Security benefit recipients. So really what they're saying is they're kicking the can down the street, but they have to deal with it. But once the government exhausts those measures, the article says it will no longer be able to issue debt and could run out of cash on hand. Now, of course, the U.S. government has never actually defaulted on its debt, and it isn't expected to this time either. Yet the threat of defaulting has come up many times, and even that has its consequences. So that's an article from CNBC. We've got it linked in the show notes. If you're watching on YouTube, you can see it there as well. But here's my thoughts. Jamie Dimon, who is the CEO of JP Morgan, one of the most powerful banks in the world, has said he's already preparing their bank for a shutdown and for a potential default, an actual default. He's doing that because that's his job as a leader of a bank. But he is a very, very intelligent leader and understands the dynamics that are taking place right now in Congress, is that the representatives have forgot that they are representatives. And they just want to get a bad deal pinned onto the other side, the other party. And they literally, the way they function, they don't care how it affects the average American.
Yeah.
Does that drive you crazy?
That does. Yes.
So I remember one time we shut down the government. Do you remember government shutdowns?
Yep.
How did it affect you? Did it affect you?
I don't. What year was it?
I would say 2016 or 17 we had one.
Yeah.
We've had some before too.
I mean, I was working, so. But I mean, I remember it, but I don't remember it like vividly.
I remember one way it affected me is I was in Hawaii speaking, and I wanted to go to Pearl Harbor.
I was working here.
But I couldn't go to Pearl Harbor.
I've been working here since 2014.
I couldn't go to Pearl Harbor because Pearl Harbor was closed because they had no money because of the government shutdown.
Yeah.
And what was crazy about it was, here is this memorial to people who made the ultimate sacrifice. I can't go pay my respects to that because the government can't get out of their own way to fix the budget, which ultimately is the real issue here. You wouldn't need to increase the debt limit if we weren't borrowing incessantly. And then on the other side of things, I sat and thought about, we went through several weeks of that. And then all these people, government employees, did not have they couldn't go to their job.
Yeah, I was going to say, I remember that. Like, a lot of people couldn't work because they weren't getting paid.
And then they got their money. They all got all their money. Yeah. They didn't work for it, but they still got backdated all their pay. So here I am as a citizen. You're a citizen. We're all tax-paying citizens. And we paid people to not work because Congress couldn't get it together. So to me, I say, Congress, get it together. And by the way, a balanced budget will solve that. Income minus outgo equals exactly zero. Whether you're dealing with dollars, thousands of dollars, millions of dollars, billions of dollars, or as the federal government does, trillions of dollars. It still works. That's it for today's current money events section.
Yes. Sounds like a, what's the word when it's like a developing story? There we go.
It is a developing story.
Yes. So keep you posted. Okay, our success story today is from Jayme, and he says, just wanted to email you that we have paid off our house. Took 7 years, LOL, but my wife and I did it. Also, by the way, the cars are paid off too. Loving the freedom. Thanks for all you've done over the years and for the encouragement to get started when it seemed impossible.
That's awesome. So think about this. This is hilarious. He said, took 7 years, LOL.
Which is like, I'm like, that's
like I'm taking it
good.
as he's saying it took forever.
It doesn't seem like
it
forever.
Doesn't seem like forever to me.
Yeah.
7 years is amazing. And I like that he said he and his wife did it, which means they were united on it, and they've paid off the cars, and they are loving the freedom. And so I think that is really amazing. He says something that's really important there, the encouragement to get started when it seemed impossible. And I think a lot of people think it sounds impossible. And so just take it from Jayme, it's not impossible. Take it from our team member, David, in an episode that we just went through where he paid off his house, he and his wife. Take it from Sean and his wife, Laura, back in October of 2020, in that episode where they paid off their house and they're 33 years old. Yeah. So, hey, good job, Jayme, and unnamed wife of Jayme.
Though I feel like the wife is always unnamed. You should ask for her name.
Well, sometimes the bride writes in.
Yeah.
And the husband's unnamed, sometimes, in fairness.
Yeah. All right. So our question for today is, mortgage rates are very low. How do I know when it makes sense to refinance my existing mortgage? We currently owe $231,703 with an interest rate of 3.75. It's a 30-year note that we've been paying on for 4 years.
Well, this is a really good question. And to do it, you have to answer some key questions. So if you're in that place where you're pondering refinancing, restructuring your mortgage, it's important to answer these key questions, and we'll have them listed in the show notes too. Yes?
Yeah.
That's great. Yeah, that's awesome. So as we walk through these questions, before we talk about how to do this, I want you to answer some key questions, and Megan's going to ask the questions, and then I'll give some color analyst commentary.
Yes. Okay, the first one is, how long do you plan to remain in this home?
Right. And that's one thing they didn't tell us. So it does matter how long you plan to remain in the home because it usually costs some money to refinance it. And in order to make it make sense, you're going to have to be in the home for a period of time. But for this example, we're going to assume that they're going to stay in the house for at least 5 years. That's going to be our assumption.
Yep.
Okay?
All right. The next question is, what is your current mortgage balance?
Right. So you need to know exactly how much you owe, not roughly, but exactly. You can do that by logging in your mortgage loan. But right now, they said they owe $231,703. And when I say exactly, you can round to the nearest dollar.
All right. The next question, what is your current interest rate?
And this matters, of course, because we're talking about should we refinance? And obviously, if it's more, you're not talking about refinancing. So their current interest rate is 3.75%.
Okay. The next one is, what interest rate is available to you?
Right. And we're going to talk about this a little more about how do you find the best rates available to you. But they said they have 2.50% available to them.
All right. And the last question is, how much does the refinance cost?
Right. Now, this really matters a lot because when you're thinking about refinance cost, a lot of people say a no cost or no out-of-pocket cost refinance. Well, listen, some of the costs may be out of pocket. Others, when they say it's no out-of-pocket cost, they're just adding it to your new mortgage. So I call that being buried in the new mortgage. So they didn't tell us how much this is. So we're going to say this refinance will cost them $4,000. And if you divide the $4,000 when we go through the math here, we're going to be able to see how long it takes to be able to refinance this. And so if the refinance costs $4,000, we'll do some math here, and we'll show you a quick way to do this math, a really quick way to do this math. Okay? So how long do you plan to remain in the home? What's your current mortgage balance? What is your current interest rate? What interest rate can you go to? And how much does the refinance cost? Those are 5 questions you should ask and have the answers to before you do the steps to get it refinanced. So what is the first step you should take once you know that?
All right. So step number 1 is shop for best rates and terms.
Right. So that's a big capital A-N-D, the best rates and the best terms. Because many banks, they understand that we're drawn to the lowest rates, but they're tricky. So they have higher fees like discount points that you have to pay for, or higher closing costs, and these origination fees that are like 1% of the mortgage balance or 1.5%. And to fix this and to be able to shop for the best rates and terms, of course, you can go to your current mortgage provider. But I really like to use a website called bankrate.com. Bankrate.com. And I use the filter to show the best deals with 0 points. So you click on a filter there and you can select 0 points paid. And that helps you get a real apples to apples comparison of what the real interest rate is that is available to you.
Yep. Okay. So the next thing to do, number 2, is compare difference in interest costs for 1 year.
Right. And so this is really important. So this is a real fast way to do a rough math calculation. So a rough calculation is a good way to start. And, you know, the difference between their interest rate now and what they could go to, 3.75 now, 2.5, what's the difference?
Yep, 1.25.
Right. So 1.25%, you can pull out your handy-dandy calculator on your phone, and 1.25% of $231,703 is $2,896. Now, I know that number is not exact, because every month the balance is going to go down. That difference is a little less, but it's a good rough comparison, $2,896. Now, if you take the refinance cost of $4,000, and divide it by that $2,896 that you'll save in the first year of interest alone, it says it will take roughly 1.4 years or 16 and a half months to recoup your refinance costs. So how do you know whether you should refinance? Well, you simply look at that and say, do we plan to be in this house for longer than 16 and a half months? If we do, then yes, we should refinance. It's that simple.
Yeah.
And so I really like to do it that way because, you know, you can get into all the weeds of amortization tables, and all that stuff is very important, vitally important. But this tells you quite rapidly, hey, look, 16 and a half months plus or minus a month. Hey, we plan to be here at least 3 years. We need to refinance this thing. And you go do it. But we have a huge tip we want to tell everybody.
Yes. So the last one is don't go back to a 30-year note.
Right.
Key. Very key.
Do not reset back. Why?
I mean, you've already been paying, first of all. So you've already made the progress. So they've been paying, they said, for 4 years. So if they go back, they're essentially going back the 4 years.
Yeah, they're down to a 26-year.
Yeah. So instead, you want to move forward, not backwards, because you're refinancing. You're getting a lower rate. You're ideally still putting the same amount. Maybe you're able to put more each month. So you're able to make more progress quicker. So...
And what do we exist here to do at the podcast? We exist to help people advance,
yes,
to climb the ladder, right?
Go forward,
not go backwards.
Yeah.
And when so many people, they get enticed because the 30-year note, oh, look, the payment is less than it is right now. Yeah. Woo, that's awesome. And this is exactly how the people that we're coaching for retirement right now still have 20 years or more still on their mortgage.
Right.
And they don't even know how that happened. Well, I know how it happened. They kept refinancing. To a 30-year note, or buying another house and going to a 30-year note. And so if you're able to afford a little more in a monthly payment, which a lot of people are, you know, over the course of 4 years, they've gotten a couple pay raises, they've gotten rid of a couple debts, well, then consider moving to a 15-year or a 30 or 20-year mortgage. And a lot of times what I like about that is, you know, a 15-year or 20-year actually gives you even better interest rate terms. Maybe typically between a 30-year and a 15-year note is at least a half a point, 0.50%. That's a big deal. So maybe you could go to 2%. Man, you could make up that ground really rapidly.
I think a lot of people too, I mean, most of the time you hear 30-year and 15-year, and you think those are kind of the only options. But the 20-year, I feel like, is a good option if you're not quite able to do the 15-year, because it is less, but it's maybe not putting the strain as the 15-year.
Right.
Where you're able to make progress quicker, but you're not having to maybe push as hard if you're not able to do the 15. If you're able to do the 15, I think that's great.
Yeah.
Big progress.
100%. But here's what I would just tell everyone. We have a mortgage payment calculator located on our wildly popular website at iwasbrokenowimnot.com. And you can type in the terms right there. And a lot of bankrate.com will calculate it for you too. Just type in your mortgage balance, put in the different interest rates, and it will be able to tell you what your principal and interest payment will be. It won't add in your taxes and insurance. You know that information. That'll remain the same whether you refinance it or not. And so you're comparing that principal and interest payment. So it really is telling you, hey, that going to a 15-year note, believe it or not, going to a 15-year note may not increase your payment that much because the interest rate is much less.
Right.
And so you may look at that and say, wow, we could do that. And how old will you be in 15 years? I don't know. You're the one listening to the podcast. You can answer that. Maybe you don't want to answer that, but when you look at it, I'm in that 47-year window. If you're looking at if you're 26 years on a mortgage right now, that's till you're 73.
Chewy.
Right? And it doesn't seem unreasonable. There's so many people, the 47-year-olds, who just started a 30-year note.
Yeah.
But when you do the math and say 30 years from now, I know it looks younger by the day, but 77 is not exactly spring chicken. I don't think. So here's what I would just say. Do 15 years. Oh, that's 62. Oh, how does that sound? Is that worth sacrificing for? Have you been able to get that last kid out of your house? Are you close? Or are you like me? Do you have a second grader? Get fired up. So I got one out of college or headed out of there.
There you go.
Help her, Jesus. Okay. So that's what I thought we'd share. I feel like it's a really quick, rough way to get to the number. What do you think?
No, I think it's great. I think doing the simple math, even using the calculator, I feel like makes it easy too, just to be able to see different numbers and percentages. And if I can get this rate, this is what it would be. If I can get this rate, this is what it would be. But I think doing just a little bit of homework, going to bankrate.com, finding different options, finding different interest rates and that kind of stuff. Or maybe you have a realtor that your family uses, and you can contact that realtor and ask them, they would be able to tell you what percentage you'd be able to get now and that kind of stuff, help you determine closing costs and all that kind of stuff too. So just a little bit of homework, you could be able to save yourself a lot of money.
100%.
Yep.
So tell everybody about our quote and verse, and I love what I came up with for that today.
Yes. So if you're watching on YouTube, you can see it's a little cartoon, but it said it's the husband and wife are walking out I guess this is the bank, right?
Yeah.
Walking out of the bank, and she's looking at him, and she said, "I told you just ripping up the mortgage didn't make us debt free."
It's awesome. Yeah, I told you that ripping up the mortgage didn't make us debt free. It reminds me of an episode of The Office when Michael Scott says, "I declare bankruptcy," and they're like, "Hey, that doesn't do it." He's like, "I declared it." So yeah, I think that's funny. So tell everybody what we're going to talk about on our upcoming episode on October 18th.
Yes. So upcoming episode, we're going to talk about how to negotiate a pay raise. So maybe your company is starting to make progress again. You kind of got through the pandemic. You're kind of, okay, things are going good again. I've been doing a lot of work, put in a lot of time, want to ask for a pay raise. How do I do that? How do I kind of handle that? So we're going to help you with some tips on how to negotiate a pay raise.
Woo, I think we'll have some people listening to that one.
Yeah.
So if you like today's episode, please help us get this podcast so other people get benefit. You can do it by quickly rating our podcast, leaving a review. That helps make our podcast better, helps other people discover it. If you're on YouTube, click the subscribe button, click the thumbs up button, leave a comment on something that has helped you from this podcast episode or something that you disagree with. We invite all types of conversation through that. And we really do like to be able to bring this to you from video standpoint as well, so you can see what the podcast looks like as Megan and I fight over this, or as we figured out, we don't really edit a lot of that stuff out. So as we're scrambling to make it work, we try to make it enjoyable as you guys can laugh at us as we try to produce a podcast episode. So, hey, it's Monday. It's a great week. Hey, should you refinance? Check out bankrate.com this week. Figure out whether or not you should be at a bank making plans to refinance this week. Have a great week, everybody.
Thanks so much for listening to this episode of the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not. If you enjoyed today's episode, please leave a review and subscribe. And for more great content and to stay up to date, visit iwbnin.com. We'll catch you next time.